When it comes to US debt and gold demand, many believe there's a direct link. Higher debt equals higher gold prices. But the reality is more complex. While rising debt can fuel inflation fears and weaken the dollar, the evidence shows that it's not the debt itself driving gold demand. Instead, monetary policy, particularly changes in interest rates and inflation management, plays a far more significant role. But why is the prevailing wisdom that debt is fuel to the fire of rising gold prices? We are about to challenge one of the biggest myths in gold investing. This misconception has misled investors for years, but today we're breaking it down with real data that flips the narrative on its head. If you're interested in cutting through the noise and understanding the real drivers behind gold and silver prices, hit that subscribe button so you never miss our insights. Just like the classic book How to Lie with Statistics shows us how numbers can be misleading, the same can be said for the connection between US debt and gold prices. We often hear that when debt rises, gold prices should follow. This narrative has been reinforced as a one-size-fits-all saying over many years by pundits in the media. Just this year, we've had several articles with titles like "Fear over government spending may sustain gold bulls" and "The Gold Rally is sending a warning about US debt." These types of narratives push the idea that as long as debt continues to climb, gold prices should too. It's not hard to guess that some people might be persuaded to invest in gold as government spending shows no sign of slowing down. But it's kind of like the old 8 glasses of water a day rule. It sounds right and it sounds like good advice, but it ignores all the other factors like a person's size, environment, and activity level. And just as hydration needs vary, gold's behavior doesn't follow a simple formula tied to debt. The blanket assumption that as debt increases so does gold price can be harmful. While there were periods, like from 1999 to 2009, when debt and gold prices rose together, longer-term data tells a different story. Debt has been rising steadily for decades, yet gold prices don't always follow. Outstanding historical debt has largely risen without pause for decades, yet gold prices fell in 2013 from then all-time highs and languished in a trading range between $1,000 per ounce and $1,300 per ounce until 2020. US debt never stopped growing. There is something of a relationship between debt and gold, but it's a bit more tenuous and not as direct as some may suggest. The most interesting association is psychological. Exploring the psychological component does offer some answers. People often link US debt and gold prices because of historical associations and a perception that both are tied to economic stability. When debt rises, there's an emotional response. Fear of inflation, devaluation of the dollar, or even government default, which drives people to think of gold as a safe haven. Gold is often viewed as real money, a tangible asset with intrinsic value, whereas debt and fiat currencies can feel less secure, especially when governments take on large amounts of debt. This psychological link dates back to times of economic crisis when gold performed well, reinforcing the belief that high debt automatically drives up gold prices. This belief, rooted in past crises like 2008, continues to shape investor behavior today. With every headline about rising debt or political instability, fear-driven demand for gold spikes, regardless of whether the data backs it up. But the data suggests that gold price reacts far more strongly to monetary policy than it does to fiscal policy, which actually provides evidence that gold is a currency. Monetary policy and fiscal policy are often confused, but they're very different. In simple terms, monetary policy is central banks managing interest rates and the money supply. Fiscal policy is government spending and taxes. There's some interaction, but they are distinct. High US debt is the result of fiscal policy, while high interest rates are the result of monetary policy from the Federal Reserve. gold tends to do well when real interest rates are low. When people can't earn much from interest, they turn to gold as a safer place to store their money. Gold is more attractive when real interest rates are lower and less attractive when they're higher. This past September, the US Federal Reserve surprised everyone with an early Christmas gift, a jumbo rate cut of 50 basis points when most analysts thought 25 points would be the most likely outcome. Gold reacted favorably by rising above $2,600 per ounce and reaching a new all-time high. In part, it was the surprise jumbo cut spurring gold demand and lifting prices of the yellow metal higher. But there was also the Fed's projections into 2025. Most board members have placed the Fed funds rate 200 basis points lower by the end of next year, which surprised and delighted markets. All markets are forward-looking, so this news spurred additional demand for assets that benefit from low interest rate environments. This shows how quickly gold reacts to monetary policy shifts, not to debt levels, but to the economic signals sent by the Federal Reserve. It's a reminder that watching the Fed is often more important than watching the national debt when it comes to predicting gold prices. So while US debt is a popular talking point, it's monetary policy that truly moves the needle on gold prices. By understanding this, you're better equipped to make informed decisions, cutting through the noise of fear-driven narratives. The psychological link between debt and gold is strong, but it's important to look beyond the headlines and focus on the real drivers. Knowing when to buy gold isn't about reacting to every debt report, but about understanding how monetary policy will shape the economy moving forward. If gold is on your radar, make sure you're keeping an eye on the Fed, not just the debt clock. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.